Hello, my name's Cameron Kusher. I'm the Director of Economic Research at PropTrack, and I'm here today to give you an update on the South Australian housing market as we head into the spring selling season. I am going to start off with a bit of an economic outlook to give you an idea of how the economy's running and where we think things are going to head from here. Firstly, starting with economic growth at the moment is extremely weak. Over the past year, the economy's only increased in size by 1%. On average, over the last 30 years, it's increased at a rate of 3%. In fact, outside of the pandemic, this is the weakest annual growth in the economy since the end of 1991. On a per capita or per person basis, the economy shrunk by 1.5% over the past year, and it's fallen for 6 consecutive quarters. So the only thing really keeping the economy growing is the fact that there's so many people coming into the country and they continue to spend. The other thing that's really supporting economic growth at the moment is government consumption or government spending, which you can see on the chart on the right. Inflation has been the economy's biggest headache over the last couple of years. We've had very high levels of inflation, and that means the cost of everything has gone up, and our wages have not kept pace with that. If we have a look at the quarterly and annual rates of inflation at the moment, both are still too high. Annual inflation is meant to be between 2 and 3%, and you can see headline inflation is sitting at 3.8%, underlying inflation at 3.9%. Now, we'll probably see headline inflation fall back into the target range over the next few quarters, and this is because of government subsidies and rebates, which are easing the cost of living pressures for some, but a lot of these measures are only temporary, and once they are removed, they will add to inflation going forward. And for this reason, the Reserve Bank is looking through that headline inflation and focusing much more on the underlying measure, which they don't forecast will come back into the target range until late 2025, early 2026. So inflation is still a problem for us for some time. And as a result of that high inflation, the Reserve Bank has lifted interest rates. So the cash rate is at 4.35%. It's been on hold at that level since November of last year, but interest rates did rise very quickly. And a lot of people that have bought over the last 10 to 15 years had never known interest rates to be as high as they are currently. The expectations now are that interest rates will fall from here, with the first cut currently being priced for February next year, which seems fairly reasonable to me, and then several interest rate cuts throughout the next calendar year. And as interest rates come down, borrowing capacities in the housing market will increase. But I think a lot of people were expecting interest rate cuts late this year, and they look very unlikely to come. Looking in South Australia, the labour market has been really strong. The unemployment rate is sitting at 3.9%. At a national level, it's sitting at 4.2%. So the unemployment rate is much lower than we're seeing nationally. On average, over the last 30 years, the unemployment rate has been 6.5%, which is actually quite a bit higher than what we've seen nationally. So it's a very tight labour market in South Australia at the moment. But you can see over the past year, there's actually been a reduction in the number of people employed. And we have started to see fewer job advertisements as well. So don't be surprised if in the next few months we start to see that unemployment rate creeping higher. In terms of the mortgage lending environment, things have been quite strong in South Australia. Subsequent buyer lending is up 30%. At a national level, it's up about 14%. First home buyer lending's up 14%. It's up about 11% nationally. And lending to investors has risen by 47.5% over the past year, whereas nationally it's up 30%. So there is a lot of demand for housing in South Australia at the moment. Moving on to the construction side of housing, of course, the federal government's housing accord has a goal to build 1.2 million new homes over the next 5 years. And one of the big challenges to this is just how much housing construction costs have gone up. There's two components of this: inputs, which are the materials, and outputs, which is actually constructing the thing. Input costs have increased by only 1.1% over the past year. They are up 34% since the beginning of the pandemic. Then you've got output costs for houses. Now you can see that the annual rate of growth has ticked a little bit higher to 4.3%, and those prices are up 42% since the beginning of the pandemic. And then output prices for other residential, which is medium and higher density housing, apartments, we are seeing quite a strong escalation in those prices at the moment, up 7.7% over the year, although they've only increased by 25% since the onset of the pandemic. But the rise in all of these prices pushes up the end cost of new housing. There's also very little prospect that these prices are going to fall. So we've now got this situation where the cost of new housing, which is generally more expensive than existing housing, that gap is a lot wider. The other area where you feel this impact is on major renovations to properties, because you incur a lot of these same costs as well. So the cost of doing a renovation on a property has increased dramatically. And with those construction costs increasing, with interest rates the highest they've been in 12 years, we're seeing less new housing being built. So you can see that there has been a fall in commencements. We've seen a big fall in approvals. There's still a lot of housing under construction, but that's because everything takes a lot longer to build now than it used to. And we haven't got that pipeline of new construction coming in behind. Now, as interest rates fall, projects will start to become more viable. And hopefully, I think for developers' sake, that the price differential between new and existing home narrows to make these projects more feasible going forward. In terms of the population of South Australia, right across the country, we've seen the population boom, and most of it's been due to net overseas migration. Most of those migrants are here temporarily as students, and that means they don't own a house. So they've been relying very heavily on the rental market. So you can see that natural increased births minus deaths is pretty much at a record low in South Australia. Net overseas migration has been at a record high. But South Australia, after a couple of years where it was seeing a positive inflow from net interstate migration, is now seeing an outflow of net interstate migrants. So let's have a look at what's happening in the established property market. Over the past quarter, prices in Adelaide have increased by 2.6%, and you can see in the black bars on the right, each region of the city has seen prices increase. In regional South Australia, things are a bit more mixed. Prices are down 0.7%, and they've fallen both in the southeast and the Barossa, York and Mid-North, but they are higher in the outback region of the state. If we take that to the last 12 months, prices in Adelaide are up 15.1%, and they're up right across the board. In regional South Australia, they're up 9.3%. But in both areas, we see that it looks like the annual rate of price growth has peaked. For some perspective, prices in Adelaide are up 15%, prices in Perth are up 23%, prices in Brisbane are up 14%. Sydney prices are up 6% over the past year, and Melbourne prices have fallen by 1.5%. So Sydney and Melbourne are certainly experiencing different conditions to what we're seeing in Brisbane, Adelaide and Perth. And a large reason for that is the amount of stock on the market and the amount of stock coming to the market. And buyers in Adelaide are still not getting a lot of new stock coming to the market. So the number of new listings in August was 6.5% lower than it was August last year. And if we look at the average in August for the 5 years between 2018 and 2022, the number of new listings is 3.7% lower than over that period. And when people start looking for a property to buy, there's not much to buy. So the total amount of stock on the market was down 14.1% from a year ago, and it's 40% lower than that 5-year average. So when people start looking, there's not much. And when they've decided maybe they don't want to buy anything that's currently on the market, they're hanging out for new listings, there haven't been a lot of new listings coming to the market. So this really feeds into that desperation from buyers to secure the right property when it does come to the market. And that's also being reflected in sales volumes. So sales volumes in August this year, despite the low volume of stock, was still 7.5% higher than last year in Adelaide. You can see in the south and west, they were marginally lower, but the central and hills and north, they were higher. And then things were a bit more mixed in the regional markets, marginally lower in the southeast and the Barossa region, much higher in the outback region of the state. We're also seeing quite a lot of demand, and we measure demand by the number of inquiries per listing. In August in Adelaide, they were up 19.5% from a year ago. In regional South Australia, the increase was even larger at 23.1%. And you can see in each of those regions, except for Central and Hills, inquiry per listing was higher this year than it was in August of last year. Which then brings us to how long properties are taking to sell. So Adelaide's one of the few markets where the median days on market's actually fallen over the past year. So it was 45 days in August this year, and it was 58 days rather at the same time last year. And if we look at the average over the 5 years to 2022, it was 72 days in August. So properties are transacting quickly, and I think this is reflective of the fact that there's not many properties coming to the market. In terms of our outlook, look, just more broadly, we've seen very strong price growth over recent decades, and that's happened as interest rates have fallen, credit availability was loosened, and then it became tightened more recently, and employment participation hit record high levels. The loosening of credit, the fall of interest rates, the increase in employment participation pushed up household incomes, and it allowed people to borrow a lot more for housing. Those three drivers aren't likely to be as strong going forward, which means we probably can't expect prices to rise as rapidly as they have in the past. Notwithstanding that, though, at the moment, the level of demand for housing is strong, especially when we consider where interest rates are and how quickly they got there. And we have seen that lift in the volume, even though there has been a slight increase in the volume of stock for sale in terms of new listings compared to a few years ago. There's still not much, and that's driving demand. That low volume of stock, if it does start to rise, and we know in spring it does typically start to lift, we could see a further slowdown in that rate of price growth. But at the moment, prices are continuing to rise rapidly because people really have this fear of missing out. There's this sense that if I don't secure this property, this one that's come to the market and is right, then I could be waiting months to get one that's appropriate, and prices could be another 5, 10, 15% higher. If we do get that additional supply, the important thing for vendors will be to reset their price expectations when they're trying to sell. I think the high cost of new housing is likely to continue to see people preference existing homes over new homes and prefer properties that don't need a renovation to those that do. We need more infill housing, but there's a lot of political and financial hurdles around delivering that. And I think the high cost of renting is likely to see more people that have the capacity to do so to become first home buyers. And we'll talk about that a little bit more when we touch on the rental market right now. So over the last 3 months, house rents in Adelaide were marginally higher. Unit rents saw a larger increase. You can see in regional areas, a bit mixed, but quite strong growth in rents for houses over the past 3 months. If we look over the last year, again, Adelaide, a bit of an outlier here, where we have seen a slowdown in the rate of rental growth, but the magnitude of the slowdown has been much less than what we've seen in most other parts of the country. The median rent in Adelaide is $580 a week. That is lower than Sydney, Brisbane, Canberra, Perth, but it's actually marginally higher than the median rent in Melbourne at the moment. And obviously, on a historic basis, we've never seen rents as high as they are currently in Adelaide. And even in regional markets, we've seen rental growth well above the rate of inflation over the past year. We are seeing, though, rental yields falling because prices are still rising at a much faster pace than rents are rising. But some really attractive rental yields are available across South Australia at the moment. And if we look at the rental supply, things are actually starting to ease off a little bit. The number of new rental listings in August was up 14% from a year ago in Adelaide, and it's now higher than that 5-year average. Similar trend in regional South Australia. And total rental listings are also starting to increase. They're up 16% from a year ago. Now, they are still below that 5-year average, but you can see things are heading in the right direction. So good news for people looking to rent. Probably bad news for landlords because they're not going to have as much capacity to put up rents. And we can see that playing out as well when we look at rental inquiry per listing, which has fallen over the past year, down 27.5%. And in regional South Australia, it's also fallen. So again, people are getting a little bit more discerning about the rental market at the moment. It's also interesting to note that it's the western suburbs of Adelaide that's seeing the highest inquiry per listing. And the central and hills, where you would probably think most people want to be, is getting the lowest level of inquiry per listing, which I think really comes back to the high cost of housing in that market. Vacancy rates are still very low throughout the state, but they have drifted higher from where they were over the last couple of years, but still very tight conditions. And we've also seen properties that are available for rent staying on the market a little bit longer. So in Adelaide this year, it was taking 19 days to lease a property. It was 17 days at the same time last year. And you can see, again, things a bit mixed. Some regions of the city seeing an increase in days on market, some seeing a fall, and equally in regional South Australia, things are quite varied. So what's our outlook for the rental market? Now, there's been a few factors driving the rise in rental prices. Household sizes reduced through the pandemic, and that was also at a time when we were seeing very low levels of new housing construction due to surging labour costs, shortages of labour, and then financing costs rising as interest rates increased. Then, when the borders reopened, we had rapid population growth, mostly from migration, and we just didn't have enough housing to respond. We have seen that rental growth continue over the past year, but the rate of growth has slowed marginally. Supply is tight, but we are getting more investors into the market, and that should help with competition in the rental market and also contribute to slower rental growth. The biggest challenge, though, is the capacity to afford rent. And there's a few ways people respond to this. They move to less ideal locations to rent, they move into a smaller property, or one of the big shifts we're seeing is a lot of people go into share housing, probably not through desire, but out of necessity, because they just can't afford to rent by themselves. So how do we solve the problems on the rental market? On the supply side, you build more housing, which even if we could fix everything that was stopping new housing being built, it would take several years for that to come to fruition. Or you get more people investing in residential property, which is starting to happen now, and I think we'll see more of that. On the demand side, we know the federal government's trying to put caps on students, and that will lower the rate of migration. That is very difficult to implement. You increase rental assistance because it is those lower income households that are most at risk of falling out of renting and into homelessness. Or the other thing you can do is help more people become first home buyers, which again, there are a lot of schemes out there for first home buyers. But when rents are going up at a much faster pace than everything else, and we already have high inflation, it is difficult for a lot of renters to save enough to make that transition out of renting and into their own home. But I think we will continue to see more investors coming into the market because there is that expectation that rents will continue to rise. And I think as interest rates come down next year, we'll see more renters looking to exit and purchase. Even though it's going to cost them more to own their own home, I think people will be willing to pay that premium to get that security that you can only get when you have your own property, as opposed to living in someone else's property. And that brings us to the end of the presentation today. Thank you very much for your time. I hope you enjoyed it, and please share these with your team, and we hope to see you again soon. Thank you.